So let us move on now. So I want us to do we are still at manufacturing account. So continuation class for manufacturing account. So we are still under manufacturing, and this is a continuation account. And to be specific, I'm going to do a question for the last sitting paper. That is December 2024. That question that was done in December 2024. The question that was done in December 2024 for manufacturing account. For manufacturing account. For manufacturing account. So it's a good question actually. So it's a good question that all of you at least you need to know. So at least we do some of the rest. So we did some question from Kitambo Kidogo. So today, I think we are going to shift our gears and at least do some latest questions. So we are going to do 2 on the latest questions. And then we shall also find another one, another question later. So another question later. But for now, let us focus on the last sitting question. So this board is quite dirty. It's quite dirty. But it is fine. So, the question is for December 2024 actually. So open December 2024 question. December 2024 question. December 2024 question. So December 2024 question. So December 2024 question. The question is question number, to be specific, is question number 5. December 2024 question number 5. So December 2024 question number 5. Boy, the question is manufacturing account. So I'm going to read the question. So the question reads that the following total balance was extracted from the books of Venus Ltd. That 1st August 2024. So we have the information there. Then additional information. So we are interested with the additional information. So in most cases, we are interested with the additional information. So number 1, we have the depreciation. All the depreciation are on straight line basis, except plant and machinery. Except plant and machinery. Except plant and machinery. Furniture and fitting is purely for office. So you need to note that one. That furniture and fitting is purely for office. So the rest are under factory. So we have the inventory at the beginning and at the end. Then inventory is sold on the basis of FIFO, first in, first out. So what came in is what will be sold first. So what came in is what will be sold first. The 200 units were produced during the year. So 2 million actually, not 200, 2 million units were produced during the year. Number 4, we have allowance for bad debts at rate of 10% between 6 to 12 months. So 6 to 12 months to 10%, then 25% between above 12 months. So any period above 12 months is 12%. And then between 0 to 5 months. So between 0 to 5 months, the allowance is 0. No allowance should be made. Now this information, if you check it, between 0 to 5, I'm going to be 38,500. Now I think there was a type in error. It's supposed to be 38 million, 38,500,000. Then 45 million, 50 million, and then 33 million, 500,000. It's supposed to be in million actually, that one. Because if we were to use it in that order, the value of data will be not it will not tally actually vizuri, because it is negligible. So you cannot compare that figure with millions. So it's supposed to be millions actually, because this one is insignificant if you compare this figure with the data in our trial balance. So for it to make it more significant, the value should be in millions. So it's supposed to be 38,500,000, 45 million, 50 million, and 33,500,000. So we have a cost plus information number 5, 20%. Electricity insurance and maintenance are apportioned at the ratio 3:1. That one is okay. So we start by preparing the manufacturing account. Required, prepare manufacturing account. Number 2, prepare the statement of profit and loss. And then number 3, ongeza number 3, it was not a requirement, but let us ongeze statement of financial position, because we have the trial balance. You can also prepare the statement of financial position, though it was not a requirement in this question. It was not a requirement in this question. So Venus Ltd. So we say Venus Ltd. Manufacturing account, manufacturing account for the year end, for the year end, for the year end. Now, what's the ending period of this account? For the year end, 31st August 2024. 31st August 2024. 31st August 2024. So kama kawaida, the question is in thousand. That one is fine. The question is in thousand. That is fine. So we start with the opening raw material. Opening raw material. Opening raw material. Opening raw material. So from the question is, you can see it's 55,000. Opening raw material. I think you can see it clearly from the question. Opening raw material is 55,000. That is inventory as first September 2023, 55,000. Then you're supposed to add purchases from material. So we add purchases, purchases of raw material. So purchase of raw material, in the question, it is somewhere there. Purchases, so unaenda kwa purchases and sales. So 225,000. So 225,000. Then we have carriage of raw material. We need to add it. So add carriage of raw material. Carriage of raw material from the question, it is 7,500. It is 7,500. You can see it clearly. Hapo kwa bad debts chini yake. So when we have the information of bad debts and trade receivables, hapo chini yake we have the carriage of raw material. Then you have return outwards. We also need to less the return outwards. Now return outwards, we have it there. Pale chini kidogo. Before maintenance and repairs, 5250. So we less return outwards. Less return outwards. 5250. Then we can less now. I'm not going to put everything. Closing material, raw material. That's in information number 1. Go to information number 1. So information number 1, raw material is 30 million. So that's 30,000. Supposed to be 30,000. 30,000. Itakuwa ni 225,000 plus 7,500 minus 5250 minus 30,000 minus 30,000. So unapata 197,250. So we add it together, we get the direct material. Direct material cost. So plus 55,000. Inakuja 252,250. 252,250. 252,250. Now once we have that, we can add now the direct labor cost. We add direct labor cost. Now what's our direct labor cost from the question? Let's go to our total balance. Let's go to our total balance. Direct labor cost, we have it direct wages. Pale kwa carriage of raw material, we have the direct wages 120,000. So wanaita, so hapo wanaita direct wages. Wanaita direct wages, same thing. 120,000. So we can get the prime cost. prime cost itakuwa ni 372 to 50. 372 to 50. Now we can add the factory overheads. We can add factory overhead. Factory overheads. Factory overheads. We can add the factory overheads, and our factory overheads, the good thing unafaa kuanza unaanza na information number 1. So information number 1 talk about depreciation. So we have the depreciation of the factory building 4% on straight basis. So we start with depreciation of factory building it is 4% of the cost. So what is the cost of the factory building? Now ukiangalia factory building huko juu, let's go to factory building in our total balance. Factory building wametuambia it is inclusive of land, so lazima tutoe hiyo land. So 175,000. So 175,000 minus itatoshea hapa kweli, tutatufanyia hapa chini. So it is 4% of 135,000 minus 40,000. Okay, actually it is in thousand minus 40,000. So how much is that? So 135,000 minus iko wapi hiyo? Ni kama nimepotea. Factory building iko wapi? Ni 175 minus 40,000. 175. 175 minus 40, that one. So lazima tutoe hiyo land because land is not depreciated. So we need to remove the land. Itakuwa ni 135,000 times 4%. Itakuwa ni 5,400. So we add 5,400. Information number 2 is about depreciation of plant and machinery. Also that one on reducing balance. Depreciation of plant. So I will just say plant depreciation of plant. Now depreciation of plant, for that one wamesema ni on reducing balance, so you need to less the accumulated depreciation. So 20%. So 20%. So we need to less the accumulated depreciation. Now we need to take the cost with less accumulated depreciation. So let us go. Plant and machinery ni 200,000. 200,000. Then we need to less the accumulated depreciation because it's reducing balance. So plant and machinery in 20,000. 20,000. So how much is that? So 200,000 minus 20,000 times 0.2. So that's 36,000. 36,000. That will be fine. So tuende kwa another additional information. First we want to complete additional information first so that we can the one which is relates to the factory. Now furniture and fitting we ignore because walituambia furniture and fitting relates to the office. So that one we ignore. That will be in the income statement. Now inventory for raw material, that one is fine. We shall do it later. Allowance for bad debts, that one will be on income statement, not manufacturing. And then we have electricity. So we have these items. So we have, I can see electricity, insurance, and maintenance. Electricity, insurance, and maintenance. So those one, we need to do some working. Electricity, insurance, and then you have maintenance. So we need to do the working for the 3 items. So wanasema that insurance, electricity, insurance, and maintenance costs are apportioned in the ratio 3:1. So kumaanisha 3 is for factory, 1 is for the administration or the offices. So 3/4. So 3/4. 3/4. 3/4 goes to the factory. Goes to the factory. So let us start. Electricity ni ngapi in our total balance? Electricity in our total balance ni 20,000. 20,000. Maintenance pale naona pia ni ngapi? Maintenance naona ni chini yake 34,000. 34,000. Insurance nilikuwa nimeona insurance somewhere. Yes, nimeiona 24,000. 24,000. So 3 over 4 of 20,000. 3 over 4 of 20,000 is 15,000. 15,000. 3 over 4 of 24,000 is 18,000. 18,000. And then maintenance 3 over 4 of 34,000. 25,500. I think those are the expenses in our additional information which relates to the factory. Now we can go now to our trial balance. So tunaanzia huko juu kwa ordinary share capital. So ordinary share capital is a item of the balance sheet. Retained earnings the same, share premium the same, bank the same, factory building the same, plant and machinery the same, furniture and fitting the same. Accumulated depreciation will affect the balance sheet also because we need to less that one because the item are on cost. Inventory, that one is okay. Purchases and sales, that is okay. Receivables and payables, okay. Allowance for bad debts, okay. Bad debts, okay. Carriage on raw material, okay. Direct wages tumeshafanya. Administrative salary, okay. Electricity tumeshafanya pale, okay. Yeah. Maintenance tumefanya pale, is okay. Return outwards, it's okay there. That one is fine. Sales and marketing, okay, in the income statement. General administrative expense in the income statement. Insurance tumeshafanya working yake hapo. Bank charges, that one is fine, that's the income statement. We have the factory equipment hire. Factory equipment hire. Factory equipment hire. Hire, which is 22,500. I think those are the items which are we can say they are under factory building. So add them together. We get the gross production cost. So we get the gross cost of production. Cost of production. So tunasema 372,250 plus 5,400 plus 36,000 plus 15,000 plus 18,000 plus 25,500 plus 22,500. So that one is 494. 494, 650. 494, 650. Then we add opening work in progress. So we add opening work in progress, and also we less the closing work in progress. So our open work in progress, if you go to our balance, our open work in progress is 40,000. 40,000. Then our closing is in the additional information number 2, 56,500. 56,500. We get the cost of production. Cost of production. Cost of production. So 494, 650 plus 40,000 minus 56,500. Napata 478,150. 478,150. I hope you're getting the same. 478,150. So kama hakuna manufacturing profit, this is what will be treated as purchases if there is no factory profit. But in this question, we had factory profit information number. That is information number what? Information number 5. The goods are transferred to the house at a cost plus of 20%. So factory profit. So I will call them factory profit. You can also call it manufacturing profit if you want. 20% of that amount, 478,150. So 20% of that answer, 99, 95, 630, 95, 630. So we can get the market value. So some call it market value or the transfer value. Other people call them the cost of production. Cost of production. Cost of production of the finished good. Of finished good. Of finished good. Whichever one you want to call it, as long it is under the market value or the transfer cost of the transfer value. So plus 478 150. So nimepata 573 780. 573 780. 573 780. 573 780. Having mentioned that one, tumemalizana na the Venus manufacturing account. I think now we can concentrate on the manufacturing account. Now we can concentrate on the manufacturing account when we say Venus Ltd. Venus Ltd. Income statement. Income statement. Income statement for the year end. For the year end. For the year end. 31st August 2024. Also in thousand. Also in thousand. So we start with the sales figures. So what's our sales figure? So you go to back to our total balance and look for the sales. So sales, we compare sales and purchases. So sales is 681,500. Sales is 681. 500. I think that one is visible from that end. 681. 681,500. Then we have return inwards or the sales return. No, we had only return outwards, which in effect the other account. So we did not have any sales return. So in that case, we less cost of sale. So cost of sales. So we need to consider the cost of sales. So we start with the opening finished good. Opening finished good. Opening finished good. So opening finished good iko pale kwa inventory or finished good 39,000. 39,000. And remember that one is for how many units? 39,000 is for 200,000 units. Now we need to add the market value or the transfer value or the cost of production. So the market value of production. So the market value of production ndio hii 573 780. 573 780. Then we less the closing finished good. Closing finish goods. This one requires a working. Now ukiangalia for our opening goods for the finished, it is 39,000. 39,000. Now the number of units is 200,000. As you can see clearly, 200,000. So you need to get the cost per unit. So you need to get the cost per unit. Cost per unit. Now cost per unit itakuwa ni 39,000 divided by 200,000, which is 0.915. So Kenya shillings. So Kenya shillings 0.195 per unit. So you need to get the closing finished good. Itakuwa ni the number of units. So what's the number of units for the finished good? So ukienda kwa finished good wanatuambia 160,000 units were complete. So 160,000 units. So we multiply the cost per unit. So 0.195. So times 0.195 times 160,000. So that 1,200. So this one becomes 31 200. That one becomes becomes the closing civil finished good. So we can get the cost of sales. So 39,000 plus 573 780 minus 31 200. It is in thousand, remember. 581 580. So we get the gross profit. Get the gross profit. So 681 500 minus answer 99 99,920. 99,920. Then we add other income, and the first income is the factory profit. Factory profit, we save space. Factory profit in 95,630. 95,630. Then we need to do a working for allowance for allowance for doubtful bad debts, so that we see if we have an increase or a decrease. So let's do a working for that one, so that we know if we have an income or an expense. So remember, an increase is an income, a decrease is an expense. So let us start with allowance in the trial balance. So we start with the allowance in trial balance. So what is the allowance in the trial balance? So allowance for bad debts in our trial balance. So allowance for bad debts in our trial balance is 17,500. 17,500. Now we need to do a working for additional information. So what about the amount in the additional information? Additional information. Now I said that for additional information, that amount is supposed to be in million. So between 0 to 5, so tunaweza na ya kwanza, between 0 to 5 months, it is 0. So naandika 0. 0. Between 6 to 12. Now between 6 to 12 ametuambia ni ngapi? Between 6 to 12 ametuambia ni 10% of the debt. So the debt between 6 to 10 ni 50,000. 50,000. So it's supposed to be in thousand, remember? Hapo wakuweka in thousand, so mimi naweka in thousand. So I think there was an error concerning that one. So to assume it's supposed to be 50 million. 50 million. So 1, 2, 3, 4, 5, 6. So let us put it in million. Tuweke hivyo. But lakini because tumeweka hapa in thousand, itabaki 5 million hivyo. So itakuwa ngapi? So 1203. So itakuwa ni 50 million. So this one is 5,000. 5,000. And then between 12 and above, we mean 25% of the aging debts. So our aging debts itakuwa ni above that one is nimefanya makosa hapa. Between 6 to 12 months ni 45. Ni 45. Then that one is 50,000. So I think this one we need to do again. So itakuwa ni 4,400. 500, and then 0.25 times 50,000. 12,500. 12,500. So that when we add them together, itatupatia 17,000. So we have a decrease. So this one is a decrease. So we have a decrease. So decrease in provincial for bad debts. Decrease in provincial for bad debts. Of bad debt. Now that decrease is 500. So it's an income. So a decrease is an income. So a decrease in provincial of bad debt. 500. Remember it is in thousand. 500. So I think we don't have any other thing. So we can add them together so that we can get the total income. Total income. Total income. Itakuwa ni 99,920 plus 95,630. 95,630 plus 500, which napata 196,050. 196,050. 196,050. Now we can less our expenses. Less expenses. So we less our expenses. So here tumemaliza now. Allowance for bad debt tumemaliza now. But remember, we shall reduce the same amount. We shall reduce the same amount also in our. We shall reduce it with the same amount in our nini. In our receivables. balances. So receivable balance must be adjusted also with the allowance for the period. So remember, for the period only, not the one in the income statement, just for the period. So remember, it must be adjusted with the one for the period. Let us see. For the period, that one is okay. So let us see. So we consider first the additional information first. So the first additional information was about depreciation, and the only depreciation available here now is for the furniture for the office. Depreciation of furniture. Now depreciation for the furniture, wanatuambia ni ngapi? 12.5%. 12.5%. Now you need to consider the furniture, the cost of the furniture, 120,000. 120,000. Because it is on straight line basis, so that one is fine. That one is direct in that manner. So 12.5 over 100 times 120,000, which is 15,000. So that's an expense. Another expense that we consider, number 2 apana, number 3 apana, number 4 apana, number 5, number 6. So easy. So we start with the electricity, the one that were apportioned. Electricity is 1 over 3. Sorry, 1 over 4 times 20,000. 1 over 4. Insurance also 1 over 4. Insurance 1 over 4 times 24,000. 24,000. Insurance, maintenance 1 over 4 of 34,000. Okay, let us do them. 1 over 4 times 20,000. 5,000, so we less. 24,000. 6,000, we less. Then 34,000. 8,500. So hiyo tumemaliza hivyo. That one tumemaliza. So tukishafanya maintenance, tukishafanya the one for depreciation, electricity, insurance and maintenance. Now we can go to additional information to our total balance. So let's go to our total balance. Tukienda kwa total balance, we can see ordinary share capital hapana, retained earnings hapana, share premium hapana, bank hapana, factory building, plant, furniture hapana, accumulated inventory hapana, purchases hapana, trade receivables hapana, allowance for bad debts hapana, bad debts 1,500. So bad debts 1,500. Bad debts 1,500. Carriage on raw material hapana. Direct wages tumeshafanya. Administrative salary 80,000. So admin salary, so mimi nasema admin salary 80,000. So admin salary is 80,000. Electricity tumefanya. Maintenance tumefanya. Return autos tumefanya. We have sales and marketing 13,630. Sales and marketing 13,630. Sales and marketing. This one is 13,630. 13,630. General admin expense. That one we have not done it. So general expenses. So general expense ni ngapi hapo? General expense ni 46,120. 46,120. We're supposed to reduce that amount. Insurance, we have done it. Insurance. Bank charges 6250. That's also a finance cost. Bank charges wanatuambia ni 6250. 6250. Bank charges ni 6250. Factory equipment for hire, that one is under manufactured, and then discount allowed. That is an expense. Discount allowed. Discount alone ni ngapi? 9150. 9150. So we get the net profit or loss. Net profit or loss. So do the working. So net profit or loss. So tunaanza na 196,050 minus 5,000. Not minus 15,000 kwanza. 15,000 minus 5,000 minus 6,000 minus 5,000 minus 6,000 minus 8,500 minus 1,500 minus 80,000 minus 13,630 minus 46,120 minus 62,50 minus 91,50. Napata 4,900 as our profit for 4,900. Then because this question is also linked with the company account, we also need to add the retained earnings for the previous year. So we add the retained earnings, brought down. So add to be appropriation. Retained earnings, balance brought down from the previous period. In our draw balance, uko June 182,750. 182,750, so that we can get now we can now get the retained earnings. Retained earnings balance carried down, and this one will go to the balance sheet. So plus 182,750, 187,650, 187,650. So according to that question, we have completed. So according to the requirement of that question, that's how you are supposed to do that question. According to the requirement of that question, that is how you are supposed to do that question. That is according to the requirement. Now, we can do the balance sheet. Though it was not a requirement, but what if they had asked you to prepare the balance sheet? So let us do the balance sheet. Balance sheet. So balance sheet tuifanyia this side. So allow me to wrap this part. Balance sheet. So allow me to do it on this side. So now what if they had asked you to prepare the balance sheet? So how are you supposed to do it? So how are you supposed to do it? Let us see now. Okay. So not bad. Not bad. So Venus Ltd. Statement of financial position. Statement of financial position. Financial position as at 31st August 2024, and we shall put it in thousand. We shall put it in thousand. We shall put it in thousand. So we start with the non-current assets. Non-current assets. Non-current assets. So we start with the non-current assets. And for the non-current assets, clearly we can say we have the factory building. Okay, we can start with the land first actually. Land, it was 40,000. Land. Then now we can think about now the factory building. Factory building. Now for factory building, the cost for factory building ilikuwa ni 135,000. Tukitoa 40,000, 135,000. I remember to remove the accumulated depreciation. So accumulated depreciation for factory building is 6,000. 6,000. And also remember to remove the depreciation for the year. Depreciation for the year was 5,400. So hii inakuja ngapi? 135 minus 5.4 minus 6. 123,600. So 123,600. Kutoka kwa factory building tunaenda kwa plant and machinery. So I just say plant. So the cost of the plant was 200,000. 200,000. We had accumulated depreciation in ngapi? So from the question, accumulated depreciation of the plant ni 25,000. Mimi nimeona vitu zangu. Iko wapi? Tumefanya nini kwanza? Oh, plant. So plant and machinery 20,000. Accumulated depreciation is 20,000. 20,000. Then we less the depreciation for the year is 36,000. 36,000. So how much will that be? I think it will be 144,000. So 200,000 minus 20 minus 36. Kutoka kwa plant tunaenda kwa furniture. That's also an current asset, furniture. Now furniture, the cost was 120,000. 120,000. We less accumulated depreciation for it. 25,000. Then depreciation for the year. So accumulated depreciation. Then we less depreciation for the year, which was 15,000. Itakuja ngapi? So 120 minus 25 minus 15, which is around 80,000. That one tumemalizana nayo. Now you can go to current assets. Current assets. Current assets. So for current assets, we know that for current assets, the first one we can start with is the bank. You can see we have the bank. Now the bank from the question you can see kopale juu 17,100. So the bank is 17,100. Now before we go to other item, you can go to receivables first. Receivables account. We need to do a working for this one. So tunaanza na the receivables amount. Ilikuwa ngapi? Receivables from the question. So receivables from the question 133,500. 133,500. Then we need to less the depreciation. So not depreciation, sorry. We are supposed to raise the provision for bad debts, which one is 17,000. If you can remember, it was 17,000. I hope you can remember that one. It will compare the increase. So 116,500. This one is 116,500. Then you can also think about the inventory now. So opening inventory kwa ngapi? So opening inventory. Sorry, not opening, I mean closing. Closing inventory. So raw material is 30,000. So raw material ni 30,000 now, mimi naona zangu. Okay, it's fine, it's okay. So nimeona. So inventory is supposed to be closing. So tunaenda kwa information number 2. Closing inventory. So we have the one for 30,000, 30 million. So because it is in thousand, so tunaweka in thousand, 30,000. The other one is 56,500. 56,500. Then the other one is finished good. No, finished good we did a working the hapa. We did a working the 31,200. So 31,200. So that one we did a working. So we add them together. So 30 plus 56.5 plus 31.2. So 117 700. 117 700. So 117 700. We did not have any prepayment, so that one inaishia hapo. Then tumemalizana na hizo. So we get the total assets. Total assets. Total assets. So tunasema ni 40,000 plus 123 600 plus 144,000 plus 80,000 plus 17,100 plus 116,500 plus 117,700. 117,700. So ni 638,900. 638,900. 638 900. 638,900. That one being said, we can do now capital and liabilities. Capital and liabilities. Capitals and liabilities now. Capitals and liabilities. And you can start with the ordinary share capital because it was not affected in any manner. Ordinary share capital. Share capital. So the amount will remain the same as the way in the trial balance. So the ordinary share capital in our trial balance, we can clearly say it is 250,000. 250,000. That one correct? Yes. Then you have retained earnings. Now retained earnings, now we shall do the one which tumefanya pale. Retained earnings. So retained earnings, we shall use that one 187,650. 187,650. Now, do you have any other information concerning it? We have a share premium. Share premium. Share premium. So you have share premium was not affected in any manner. Huko tu juu 100,000. 100,000. Now I think those are the items. Now you have to non-current assets. Non-current assets. At assets. Not what assets. Non-current liabilities. So I think there was no any non-current liabilities from the question. Nikiangalia, we have a loan or those items, long-term loans, blah blah blah. There were no any loans, so hiyo inaishia hapo. So but we had current liabilities, the payables. Current liabilities ilikuwa current liabilities ilikuwa, and to be specific, it was the payables. So payables ilikuwa ya ngapi from the question? Payables account ilikuwa ni 101 to 50. 101 to 50. When you add them together, so you're supposed to get the 638,900. I don't know if that is correct. So we say total capital and liabilities. Total capital and liabilities. So let me add them for confirmation purpose, just to confirm. 250 plus 187.65 plus 100 plus 101, 101.25. So 638,900. That one is okay. So that's how you are supposed to do that question. That was for December. That was for December 2024. December 2024. Question number 5B. December 2024. Question number 5B. December 2024. Question number 5B. So I can do another one extra question. That will be the end of that question. So we can do an extra one. What is the time? Not bad. So let me see the workload of the other question. Kama ni sio mrefu. So the other question is for August 2024. Not August actually, April. April 2024. April 2024, or that would be your assignment actually. April 2024. April 2024 question number April 2024 question number 3. April 2024 question number 3. So April 2024 question number 3. April 2024 question number 3. I think that one we can do it another day. So April 2024 question number 3. So April 2024 assignment 2024 question number 3. But that one I've done in another video. That one has been done in another video. That one has been done in another video, and also another one that has been done in another video. I think those. I'll do another 2 question extra 2 question tomorrow. So I'll do an extra 2 question tomorrow. But for now, let us call it the day for that one. So we meet tomorrow.